Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're going into a standard we haven't talked about before, IAS 37 provisions. It's been around for years, but we have not talked about it in all 56 episodes or however many we've done. And I've got a new face in the studio. Welcome, Andrea Locco, UK partner. How are you?
I'm very good, thanks.
Are you excited about your debut?
I'm very excited about my debut, Ruth.
She looks excited. So we'll crack on. We don't have much small talk. It's all about provisions, I'm afraid. So we'll go straight in. What is actually in the scope of IAS 37? How do we get in there?
Yeah. So actually, IAS 37 is sort of what we say is at the bottom of the scope waterfall for liabilities. So it sort of means it scopes lots of things out. It scopes out anything liabilities that are covered by other standards. So liabilities like lease liabilities, financial liabilities, insurance contract liabilities, share-based payment liabilities, pensions, all that type of stuff is covered by other standards. But if it's not covered by other standards, it generally falls into the scope of IAS 37. There is a definition in IAS 37 of what a provision is, and it's a liability that has uncertainty associated with either timing or amount.
Okay, perfect. So really, you go to everywhere else first.
Yep.
And then I like how you describe it as the bottom of the waterfall. I feel like it's the dustbin.
Yeah, it's the dustbin. Everything goes in there.
It just scoops up all the rubbish at the end.
Yeah.
Don't know where to put liability. I'll put it in IAS 37.
You've got to go to IAS 37, look at IAS 37, see what it says.
And so what's some examples of what ends up there?
So I think the most common examples of IAS 37 liabilities are things like onerous contracts, restructuring provisions, legal provisions. That type of stuff is going to fall into the scope of 37.
Perfect. And you mentioned a little bit about the definition there, but what is the criteria to actually recognise a provision in the standard?
So there's three criteria to recognize a provision. The first is that you have a present obligation arising from a past event. The second is that you have a probable outflow of resources. And the third is that you can make a reliable estimate. So if you apply that to something simple like an onerous contract, you have a present obligation from a past event if you've signed a contract in a sense. Your outflow of resources might be the costs the entity might incur to fulfill that contract. And a reliable estimate is how do you estimate those costs. So that's sort of how you apply the criteria. It does have a probable criteria, so things that fall below the probable criteria, if there's not a probable outflow of resources, then you do not recognize a provision.
And then the standard talks around, I know we're not going to focus on it today, but about like what's contingent liability, and then there'll be disclosure around that even if you're not recognising something.
Exactly. So if you're not recognising something, there is some disclosure requirements around it. The other thing that sits in IAS 37 actually is some information about actually when you can recognize things like contingent assets, and that sets a much higher threshold for recognition of an asset, and so that needs to be virtually certain. So it's a different virtually certain. So
it's like high up in the percentage world.
That means you basically have the cash in hand, I would say, is sort of the contingent asset. The other thing I suppose around kind of the recognition criteria is this idea about can you reliably measure something. And as I said, sort of the definition of a provision is that there's uncertainty in timing and amount. So just because there's a bit of uncertainty doesn't mean that you can't reliably measure. So I would say that is generally a very high threshold. It is rare that we would say you do not recognize a provision just on the basis that you can't make a reliable measurement. Where you might see this type of thing is in some sort of kind of legal provision or product liability type stuff where it is just really difficult to understand kind of the outcome cause and there's lots of activity going on. That is an incredibly rare cases. We might see somebody say, I can't recognize it because it's not, reliably estimated.
Okay. Perfect. And so in your day job as a technical guru, where do you get lots of common questions around IAS 37?
Yeah. I mean, the most common question we get around IAS 37 is, can I or should I recognize an onerous contract provision? I mean, that is really the most common question. And actually, I probably spend most of my time telling people that they can't recognize provisions when they want to recognize provisions. So, and I think this comes from the fact that it's very unusual to enter into an onerous contract, right? It doesn't make commercial sense to enter into an onerous contract. So quite often, entities will commercially enter into contracts that will give them a loss because they want to enter into a new market, or they're trying to build up capability in a particular project or product or something like that. So you do see companies a lot of time to enter into loss contracts, and they say, well, can I book an onerous contract provision, or should I book an onerous contract provision? And depending upon how a company or an entity is communicating that contract and the results of that contract to their investors, they might want to recognize an onerous contract. They might not want to. But actually, in the concept of evaluating onerous contracts, you have to consider the contract position, kind of the wider economic benefits you're getting from a contract. So, even if your outflow of resources is higher than the actual cash coming in from the contract, you do look at things like wider economic benefits, like getting into a new market, getting new customers, when you're evaluating whether something is onerous. So actually and it's a very tricky area, and it can be quite judgmental to say, how do I measure those wider economic benefits? So you sort of start with this premise that you can't enter into an onerous contract, or entities aren't going to enter into an onerous contract, but it just raises a number of questions about then when do you actually recognize an onerous contract? When does it happen? When does something become onerous? And it's normally when something turns bad.
Yeah, something happens. Yeah, I was going to say, most of the time I imagine people would go into it thinking it's not onerous, but then something happens that ends up that it's an onerous contract. That's a really interesting concept. So it's not just, I imagine a lot of people go in and go, these are my cash outflows, these are my inflows. Outflows are more, I've got an onerous contract, whereas actually it is a much broader. Why commercially did you go into that in the first place? People need to think about.
Exactly. And because you're looking at wider economic benefits, that's obviously not something from an accounting standpoint is recognized anywhere on the books of record. So even if you enter into a contract, for instance, that has wider economic benefits, that's operating at a loss at the beginning, and halfway through it goes bad, and you go to measure it as being onerous. Well, how much of that is onerous? How much of that is just the initial loss associated with the wider economic benefits, or versus additional loss that you've incurred as you've been delivering on the contract?
Yeah. And what about any issues where I've seen before is like around measurement, maybe discount rate, things like that?
Yeah, so I think that's the other common thing that actually we see people get wrong. Within the provision standards. Yeah. So it is quite difficult, obviously, because you use a different discount rate in every set of standards. But in provisions, you're using primarily people use a risk-free rate, and they are applying that to risk-adjusted cash flows. So a risk-free rate is obviously generally much lower than a rate you would use, for instance, in an impairment review, right, which would be some sort of risk-adjusted rate. And sort of the rationale behind that is that the concept in the provision standards that is the entity itself is settling the liability. And so what they're trying to avoid doing is entities' own credit risk being kind of included into the measurement of the liability. If they are settling their own credit risk isn't included. And the other thing that people get wrong is they tend to say, well, I'm not going to risk adjust my cash flows, I'm going to risk adjust my rate. But technically, if you're risk adjusting a rate in the concept of a liability, that rate's going to go down and not up. So it's going to make your liability bigger. So this is an area that people need to be quite careful of, and it's something we've seen the regulators pick up on as well.
Okay, so risk-free rate, always a tricky one of where to get that from. And then I like to go through everything. So we've talked about like recognition, measurement. There's always issues with disclosure.
Yeah. There's those issues with disclosure. That's right. And I suppose the basic disclosure requirements around provisions is you need to sort of show a roll forward of provisions. And actually, what can be sensitive about the roll forward of provisions is you actually show what of those provisions have been utilized versus released. And that's trying to show that you made an estimate at the beginning, what actually are you utilizing versus actually just adjusting an estimate. The second thing that you really need to disclose is actually just some kind of information about sort of that uncertainty of the timing or the amount. And actually quite a number of people actually leave that out. If the provision itself is a kind of key estimate, so a significant estimate in accordance with IAS 1, that's where you start to get in providing sensitivity disclosure. So that's additional disclosures on top of what the provision standard includes. I say the final thing that kind of is really sensitive about IAS 37 and the disclosure requirements is about the provisions that aren't recognized, which Ruth, you alluded to earlier. So this is when you have kind of contingent liabilities. And there are some disclosure requirements around that. And some of those disclosure requirements are quantitative. So despite not having recognized anything in the financial statements, you might need to disclose kind of a range, for example, for something that might happen, but it isn't probable yet. And that actually can be quite sensitive if you're talking about things like legal settlements. And quite often, it's a difficult area to discuss.
Yeah, and I've heard before people like push back saying, well, I don't want to make this disclosure because it's in a legal case and it's highly sensitive and it could swing the case. And there isn't that concept in IAS 37 that goes, oh, well, if it's sensitive data, you don't have to write it down, which is always a challenging, like how much information do people want to put in one and to satisfy the disclosure requirements.
Exactly.
So you mentioned with onerous contracts and discount rates, I think, that the board is doing something about IAS 37. What's going on? The board's looking at the old standards.
Yeah, well, I mean, I'd say that the ISB has been threatening to look at IAS 37 for a number of years.
Anyone
actually,
from the board that's listening, no, you're not really threatening.
But they did do a project kind of a number of years back, just looking at sort of the measurement. And I think because there's some difficulties around it. There's some inconsistencies around, one, how people apply the standards. There's questions around why is the discount rate different in the owner's contract standard versus the impairment standard, because those standards have a tendency to interact quite often. So a number of questions and issues in practice that the ISB has sort of been toying with looking at. So they have kind of restarted a research project on this, and it is a new research project. So they closed the old one. They're going to start a new one to go back and sort of look at these some of these issues. It's still supposed to be fairly limited in scope, so I don't think they're going down the path at this point in time of doing a wholesale rewrite of IAS 37.
We're not going to have IFRS 18 provisions.
No, well, not anytime soon. Not anytime soon. The other thing they just actually finished was a research project on discount rates, which actually, with provisions was one of the topics, and it does sort of outline or acknowledge that different discount rates are used in different standards, and again, the output of that wasn't that they were going to change the discount rate that's required in each one of these standards. It was just more of an acknowledgement in them for something that for them to be thinking about in the context of future standard setting. So that's the broad stuff that the ISB has been kind of thinking about. And as I said, it's sort of been regenerated this year. The one sort of a big thing that they've looked at in particular this year is something that's come out of the implementation of IFRS 15. And so prior to the application of IFRS 15, you used to have two types of contracts. You used to have kind of contracts for goods and services, and you used to have construction contracts.
IAS 11.
IAS 11. And IAS 11 provided specific guidance on how you basically recognize loss contracts in the scope of that standard. And it was, I call it kind of the fully loaded approach. As soon as you got to the point where your contract was in a loss position, you recognize the entire loss at that point in time. If you were looking at contracts that were under the scope of IAS 18, so a normal goods and services contract, you go off to IAS 37, which has a different model in essence for measuring an owner's contract. It is a kind of a least cost of exit or least cost to fulfill model. So it's more of an incremental cost model. So historically, that's what entities have been doing. There's kind of mixed practice in how you define those, but generally there were two different models. When IFRS 15 came in,
throws it out the window.
Yeah, gone. So IAS 11 went out the door. Then you just have one standard IFRS 15 in every contract that is in the scope of IFRS 15 falls into IAS 37 to analyze, to determine whether it's an onerous contract. So the old fully loaded kind of IAS 11 model seemed to disappear. And actually, it was one of these things that I would say was identified a little bit late in the game. So industries that had previously applied IAS 11 hadn't quite caught on to the fact that this was going to be a change for them when IFRS 15 came in. So it's quite a bit of pushback of, okay, well, now that I'm moving into this IAS 37 model, which is this least cost of exit or cost of fulfill model, how do I define incremental cost? Do I include things like overheads? And so that's something that actually has been now through the interpretations committee in the board, and they've put out an exposure draft, which the comment period I think has ended this year in May, to clarify actually how you might measure the cost side of the owner's contract. So it doesn't address the inflows and the wider economic benefits point, but it does address how you define the cost. And interestingly, it's getting a lot of debate, because what it has said is, well, we're not really going to we're going to define incremental costs slightly more widely. You can include things like overhead, which in essence, in substance, gives you a bigger provision, and a provision probably closer to what you would have had under IAS 11. But it doesn't really, it hasn't sit well with everyone. There's mixed views on it.
So we're expecting quite a few comment letters.
So there were quite a few comment letters. There were quite a few comment letters. And
have you read every single one?
No, I have not read every single one. I've read the board's summary of the comment letters, which is very good. But really, sort of, there's two schools of thought. One school of thought is, this makes complete sense. This is how we've done it. If you enter into a loss contract, you should take all the costs associated with that contract and recognize it a provision. The owner's contract provision should capture all of that. The other school of thought is saying, well, actually, it really should just be incrementals, because entities, as they're entering into new contracts and they're pricing new contracts, economically, they might only be trying to cover, for example, their variable costs, not their fixed
everything
costs, not everything, right?
Yeah.
So as entities are pricing contracts, you could have an entity enter into a contract which they, know if on a fully loaded basis as at a loss, but their manufacturing facility isn't at full capacity, or there might be other reasons why they're entering into it. And if you actually apply strictly what the boards have proposed, you might think, well, I'm almost getting into that position where I'm entering into a owner's contract from the beginning, which again doesn't make sense. Yeah. So, how the boards are going to reconcile those two views is sort of it's unknown at this point in time. But it certainly came through in the board's initial conversations around the comment letters that have come in.
So it's exciting. We've got something to watch at the board now.
Yes.
And maybe when we get further on in the project and we actually get amendments, you could come back and tell us what actually happened.
Oh,
and give us the inside gossip.
Looking forward to it, Ruth. Looking forward to it.
So we're coming to the end of our time together. I feel like you could talk about provisions for days, Andrea. You love it. I didn't know IAS 37 was your favourite standard. IFRS 15, surely. What's your favourite standard?
It's got to be 15 just because I know that I can answer most questions about 15.
Still, I've not found someone other than me that likes IAS 41, but one day.
No, sorry.
I'll find someone. Okay, last question then, coming to the end. Is there anything companies should be thinking about now?
So I think right now, what are the main things people should be worrying about with provisions? I would, take a second look at the discount rate you're using, because the regulators are starting to look at that. We're seeing some more questions around that. So that's sort of old stuff. The other thing is just look at, have a second look at your IFRS 15 contracts, especially if you were applying IAS 11 before. Think about the guidance that's out there under IAS 37 and are you applying it correctly? The second bit, I guess, that's probably good news is those companies that are sitting on onerous lease provisions. They don't need to worry about those anymore. So those are going to, in essence, be subsumed into the application of IFRS 16. Right. So you're not going to have onerous lease provisions on the books anymore. So those things go away. So those are kind of the things that people should be looking at, going through their provisions and saying, okay, have I gotten rid of all my onerous lease provisions on transition to 16? Am I looking at my owner's contracts correctly given the change to 15? And am I using the right discount rate?
Perfect. Thank you. So I can't believe, Andrew, this podcast has been going 2 years and we've not had you in the studio. So we definitely want you back. But that was all about IAS 37. If you want any updates, then I'm sure we've got plenty of stuff on Inform, and obviously keep a note of that board project that's going on specifically around onerous contracts. I think that's probably the most pressing thing that's changing. Just a little note from me. I don't know if Andrew knows, this is my last podcast for about 6 months. I'm going off to have my second baby. Give the viewers some exciting gossip about me they probably don't care about. And the lovely Dave Waters, who has been here many times, is going to take over as host. So we are going to take a couple of weeks off over summer. So Dave will be back in September and he will do a marvellous job, I'm sure. You'll have loads of jokes. He loves deferred tax, watch out. But I've been your host, Ruth Breedy. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.